Well, just over a half hour ago, the Bureau of Labor Statistics released its November CPI report, giving investors a fresh look at the state of inflation. According to the BLS, headline inflation grew by 2.7% year over year. That's well below the 3.1% economists expected. It was the same story for core CPI, which excludes the volatile food and energy sectors. That figure grew by 2.6% on an annualized basis, compared to economists' expectation of a 3% jump. The BLS added that no month-over-month data was collected due to the government shutdown earlier this fall. Joining me now is Ben Emmons, founder and CIO at FedWatch Advisors. Ben, welcome to the show.
Good morning, Ashley. Good to be on.
All right, so let's start with the November CPI report. Numbers came in a lot lower than expected. What are you taking away from the data?
Yeah, as you said, it was a surprise. People were expecting higher inflation. And prior to the number, although there was no collection in October, there were a lot of inflation surveys out from consumers in particular, that all showed that the expectations were going up. So it's indicating to economists that this may have been just a hotter number, but when we actually got this number now, it's a head scratcher. It's like a downside surprise, but also a head scratcher. Like, why can this be weaker? And I guess it really was driven ultimately by gasoline prices and shelter and apparel, because those were the main categories that they were able to measure, and they were all softer. So I think this changes a bit the expectation again. I can see from the Fed expectations that now markets expect a 40% probability of a rate cut by next year in March. That's quite a bit of a jump. So I think markets are taking this as a surprise.
All right, and what impact could this number have on Fed policy heading into 2026?
Well, I think it somewhat vindicates the views of some Fed members that like Chris Waller or Stephen Myron, that they're saying, look, inflation is going to decline faster towards our target than everybody's thinking. And a number like this is definitely suggesting that. If that is the case, then the Fed could resume with rate cuts in the first few months of this year, and that's actually not priced in currently. So we'll see. I think it still takes a couple of more weeks of data for the Fed, sort of come together on this idea that they could resume cuts, because they were kind of cautious. But this data, I think, is definitely giving them some fuel to think about, like, we may be in a different trajectory with inflation than people think.
How heavily, Ben, does the Fed weigh these economic data points when deciding on potentially making a rate cut?
Well, generally they do, because this Fed is definitely about always looking back at this sort of data instead of looking forward. And they also take this BLS data as their key data, and getting all this data in now, as Powell was saying last week, he said, we're getting more data in December. That will give them a good picture to make that decision eventually in come January, which will be at the end of January. So they have some time. So I think this matters a lot, data points like this. So same with the payroll report, was weaker. And so they will make that judgment to say that if it continues to stay on that trend of a rising unemployment rate with inflation declining, then they have room to cut. So I think we'll see how it plays out, but this is encouraging, at least for those expecting rate cuts.
Meanwhile, the Labor Department also just released new weekly jobless claims data. When you also factor in the 4.6 unemployment rate as reported by the BLS on Tuesday, what are you making of the jobs market?
Well, there's actually some positive things happening. So these jobless claims are somewhat subdued. They're kind of sort of like oscillating at this low number around, say, 220 average. And that implies an unemployment rate that shouldn't rise too much from here. But the reason why the unemployment rate is actually going up over the last 2 months is that more people are coming back into the labor force, I guess feeling confident that they can find work, and therefore you're getting more supply of labor, and therefore the unemployment rate goes up. It's kind of mechanical, but that's how it works. And these jobless claims, on the other hand, show that not many people have to seek out unemployment insurance because they're out of work. So I think there's some things happening there, at least on that front. On the other side, you also have other indicators like the more long-term unemployment indicators that are kind of sticky. They're sort of showing that people, that more people are out of work for longer. That's still a concern. I think that's where the Fed still looks at a lot when going forward from here, using rate cuts to prevent that situation from getting worse.
All right, and according to the latest data, a majority of traders are anticipating interest rates remaining unchanged in January. How many cuts do you foresee from the Fed moving forward next year?
So I'm in the camp of sort of probably between 1 to 2 cuts, depending on this trend of this type of data that we just got. Like, so if we continue to see the unemployment rate go a little bit high and the inflation rate go a little bit lower, the Fed could actually do more and probably will do more. But at this moment, with this economy where it is, it's somewhere between 1 to 2 cuts. And that's sort of where the market is too. I think people generally have said like the economy is actually not in a recession of any kind. So this is all just insurance. And at some point, you don't need to take out more insurance than required, right? So that's why I think people are cautious on seeing a big rate cutting cycle as opposed to a shallow one.
All right, and Ben, how much do you think a new Fed chair can alter your projection when it comes to the amount of cuts we see next year?
Yeah, that's an interesting question because, as of January, we will have this new Fed chair announced, and he will come into effect in May, unless Powell steps down sooner. And yes, it could change things, but we have to remember that although this next Fed chair may be very aligned with the president and making a strong case for rate cuts, he still has to sway most of the Fed board and other members to actually vote for a rate cut. And that is a process. It's a process based on data. I think any of the candidates we're seeing right now, first of all, Kevin Warsh and Kevin Hassett, all of them have said the same thing. Yes, rate cuts are possible, but we base it upon data and consensus within the Fed. So I think ultimately it's not going to be this game about the Fed chair comes in and swinging out and say, forget about all this data, cut rates and just listen to me. That's not the way it's going to play out. It's going to be a consensus process. So I think this Fed chair has to build relationships with others in the FOMC to come up with the right decision, to lead the economy forward.
All right, thank you, Ben Emmons, founder and CIO at FedWatch Advisors.
Thank you, Ashley. Great to be on. Thank you.
Good to see you.